Hey everyone. The other day, I had a meeting with some very sophisticated investors. They're very knowledgeable and very much in tune with what the financial media has been saying about the commercial real estate market. During the conversation, they referenced a fairly recent report produced by the National Bureau of Economic Research, which basically said commercial real estate continues to pose a significant risk to the banking sector. They also referenced comments by a variety of talking heads on the financial news who continue to focus on an impending commercial real estate driven catastrophic financial market meltdown. And as I pointed out in that conversation, yes, it's possible commercial real estate could negatively impact the banking sector and the financial markets, but that's not really the most likely scenario. At least at this point, we're not seeing that level of risk, and in all honesty, we're already, hopefully, on the backside of the risk cycle. If you look at CMBS delinquency rates, they're generally low compared to prior crises. And the term delinquent means that a payment is 30 or more days late. Now I have to point out, being 30 days late on a payment is a far cry from foreclosure. But nonetheless, let me walk through the CMBS delinquency rates for a few different property types. The current CMBS delinquency rate for apartments is 2.6%. To put that in perspective, the average delinquency rate between 2016 and 2019 was just 2.4%, and that was when apartment performance was looking quite good. Multifamily delinquencies peaked in the pandemic era at just 4.5%, and during the global financial crisis, delinquencies peaked at 16.9%. So, at least for CMBS loans, there are no signs that multifamily sector mortgages are anywhere near crisis levels. But what about retail? Just the other day, I saw an article saying retail was facing a crisis. Well, retail vacancy rates are at or near a 20-year record low, while rent growth is on the upswing. The current CMBS delinquency rate for retail is 6.3%, which is higher than multifamily, but retail generally has a higher delinquency rate than the multifamily sector. The average delinquency rate for retail between 2016 and 2019 was 4.1%. Retail delinquencies peaked during the pandemic, basically when all the retail centers in the entire country were closed, at 18.4%. So while retail delinquencies are a little bit elevated, again, we're not at crisis levels. Another property type that I hear about delinquencies is hotels and lodging. Again, hotel occupancy rates are almost back to pre-pandemic levels, but the average daily rate for hotels are up significantly. Full-service hotel nightly rates are 24% higher than before the pandemic, while limited service rates are 20% higher than before the pandemic. The current lodging CMBS delinquency rate is 5.5% compared to the 2016 to 2019 average of 2.7%. But they're dramatically lower than the peak during the pandemic when 24.3% of lodging loans were in delinquency, or the 19.5% lodging loan delinquency rate during the financial crisis. But what about office? Office has been hit hard. Vacancy rates are at a record high, while rents have been flat at best. Surely, office will demonstrate a real estate crisis. Well, the current CMBS office loan delinquency rate is 6.3%, and the average between 2016 and 2019 was 5.1%. But I'll also point out that the average CMBS office loan delinquency rate in 2017 was 7.2%, higher than it is now. And during the financial crisis, the office delinquency rate peaked at 10.7%. So again, a little elevated, but I don't think it's a crisis, at least not yet. Now, I'm just going to skip industrial because the current CMBS delinquency rate for industrial is 0.4%. So here's my point. Yes, we face risks. The rapid increase of interest rates has definitely been a headwind for the real estate sector. And although CMBS loans are not fully representative of all the lenders out there, and yes, it's possible there are banks with disproportionate amounts of risks, we just haven't seen that much delinquency or distress in the commercial real estate market. In addition, the FDIC and the Fed have provided guidelines enabling banks to work with their clients to extend loans, or to create some other alternative to address maturing debt and reduce the risk to the banking sector. Given the fact that the economy is outperforming expectations and inflation has come down significantly, it's widely believed that the Federal Reserve will begin to reduce rates this year. And if that's the case, many of the commercial real estate risk factors will begin to decline, and risks of massive commercial real estate failures should go down. So while it's possible we could have a commercial real estate driven financial catastrophe, the evidence just isn't showing up in the property fundamentals, and it's not showing up in the mortgage delinquency rates. I'm just not seeing or hearing about a wave of property owners handing the keys back to banks. Granted, these are not the best of times for commercial real estate, but they're also not the worst of times. And based on the current trends, the outlook is getting stronger. But as always, investors need to keep their eyes on the horizon.